Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge Weekly Podcast. Today's date is the 1st of December. Let's dive into the week's top market news. European equities rally as fiscal tightening and mixed economic sentiment define the regional outlook. European equity markets demonstrated robust performance recently, with the Pan-European Stocks Europe 600 index closing 2.35% last week, higher in local currency terms. This positive momentum was broad-based across major national indices, led significantly by Germany's DAX, which surged 3.23%. Gains were also observed elsewhere in the region, with the UK's FTSE 100 climbing 1.90%. France's CAC 40 advancing 1.77%, and Italy's FTSE MIB recording an increase of 1.63%. On the macroeconomic front, recent regional data suggests that inflationary pressures are stabilizing near the European Central Bank's 2% target. November figures indicated that French consumer prices rose 0.8% year-over-year, consistent with October's levels, while inflation in Italy decelerated to 1.1% from the previous month's 1.3%. Spain also saw a slight easing, with inflation dropping to 3.1%. Market participants are now looking toward the December 2nd publication of aggregate Eurozone inflation data, where analysts expect a reading of approximately 2.2%. In the United Kingdom, the fiscal landscape is tightening following Chancellor Rachel Reeves' announcement of the 2025 autumn budget. The plan outlines approximately £26 billion in tax increases, marking the second consecutive year of hikes, intended to bolster public finances. Key measures include an extension of the freeze on personal tax thresholds, a surcharge on high-value properties, and increased taxes on investment income. Consequently, the Office for Budget Responsibility (OBR) has lowered its economic growth forecasts and projects the total tax burden to reach 38% of GDP by the 2030 to 2031 period. However, the OBR notes that these tax increases are expected to drive roughly three-quarters of the planned reduction in government borrowing over the next 5 years. Meanwhile, Germany presents a divergent economic sentiment. The corporate sector showed signs of strain as the IFO Institute's Business Climate Index fell unexpectedly in November due to rising pessimism. Conversely, consumer sentiment appears to be turning a corner. Data from GfK and the Nuremberg Institute for Market Decisions reveal a modest improvement in consumer confidence heading into December. This shift suggests that an increased willingness among households to make purchases is currently outweighing broader concerns regarding income and the economic outlook. Now our insight into alternative markets. Beyond the hype, AI infrastructure is a defensive anchor against the speculative bubble. While equity markets question the sustainability of the astronomical valuations reached by chipmakers and software startups, smart money is steering capital in a decidedly different direction: land, concrete, and, above all, power. The physical infrastructure of artificial intelligence represents an investment opportunity today that is structurally uncorrelated from the speculative froth characterizing the listed technology sector. It is within this context that private equity is transforming the AI gold rush into a transparent asset class resilient to short-term fluctuations. A fundamental distinction in this scenario lies between the application layer and the infrastructure layer. The fear of a bubble similar to the dot-com era appears legitimate if one looks exclusively at the trading multiples of certain technology firms. However, there is a substantial difference between betting on which player will win the race for large language models (LLMs) and investing in what is indispensable for their operation. The focus of institutional investors is shifting toward hard assets, data centers, power generation, and connectivity, which constitute the backbone of the new digital economy. In a historical dynamic reminiscent of the railroad expansion of the 19th century or the electrification of the 1920s, these infrastructures are destined to retain their intrinsic value, regardless of which specific software application dominates the market in the next 5 years. Unlike software, which by its nature can be replicated or technologically superseded rapidly, AI infrastructure is protected by physical barriers to entry that are difficult to surmount in the short term. Private equity funds are acquiring and developing assets that control scarce resources, creating genuine defensive moats. The currency of the future in this domain is not data but the megawatt. Obtaining permits to connect new data centers to the power grid requires years of bureaucratic processes. Consequently, those who hold sites with guaranteed power access and strategic land in proximity to interconnection nodes possess an asset whose value is destined to rise due to the rigidity of supply. What makes these investments particularly attractive compared to technology venture capital is the contractual structure, which ensures transparency and independence from volatility. While an AI startup must constantly acquire new users to justify valuations, an infrastructure project financed by private equity is often founded on long-term offtake agreements. These are multi-year leases, often 10 to 15 years, stipulated with investment-grade counterparties, specifically the major hyperscalers such as Microsoft, Amazon, or Google. Such agreements provide that the client pays for the reserved capacity regardless of actual usage, transforming the technology investment into a predictable cash flow, akin to a quasi-bond return and immunizing the investor from the daily oscillations of the Nasdaq. An interesting historical parallel, useful for understanding current market discipline, is the fiber optic bubble of the late 1990s. In that instance, many companies failed for having built networks speculatively, anticipating demand that had not yet matured. Today, the private equity approach is diametrically opposed. The construction of data centers for AI occurs almost exclusively on a build-to-suit basis or against pre-signed contracts. The high capital intensity required leaves no room for blind speculation, imposing a market discipline that prevents the oversupply typical of bursting bubbles. Finally, the analysis shifts from aggregate volumes to unit economics. Instead of focusing on the TAM, total addressable market, often inflated in analyst estimates, infrastructure investors evaluate the profitability of the individual project net of energy and capital costs. The key metric is not the generic growth of AI, but the return on invested capital ROIC for every megawatt installed. This pragmatic approach ensures that the investment remains sustainable even in a potential scenario of AI market consolidation. In conclusion, while the software ecosystem may face a necessary correction shakeout, the underlying infrastructure is positioned to generate compounding returns in the long term. Investors positioning themselves in these physical assets, prioritizing contractual discipline and the control of scarce resources, are building resilient portfolios capable of surviving and thriving well beyond the current phase of hype.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.